What is an exchange? An exchange is a marketplace in which securities, commodities, derivatives, and other financial instruments are traded. The core function of an exchange is to ensure fair and orderly trading as well as efficient dissemination of price information for any securities trading on that exchange. Exchanges give companies, governments, and other groups a platform to sell securities to the investing public. In order to let an exchange functioning properly, it's necessary to have three things. First of all, rules through which it's possible to regulate trading activities, to define who is authorized to trade, to set what are the securities, stocks, bonds, and derivatives to buy and to sell. Second, supervision authority, whose role is strictly necessary to define rules and to supervise a proper functioning of the markets. Third, microstructure as, for example, timetables, techniques through which it's possible to fix prices or how to liquidate contracts. What are the main actors involved? Three main categories of operators are involved. First of all, issuers. This means who issues securities that are traded. The most important issuers are represented by governments that issue government bonds and companies that issue stocks and bonds. Stock exchanges have a lot of companies who, for many reasons that you can discover later, decide to go public, issuing equities and raising money. The leading stock exchange in the world in terms of capitalization is nowadays represented by the New York Stock Exchange, where something close to 3,000 companies are listed. Second, securities are bought and sold by investors. Two main categories of investors do exist: retail investors, as individuals, and institutional investors, as banks, funds, insurance companies. Normally, a major part of the trading volumes is driven by institutional investors. Investors are attracted by markets where liquidity and information are better and where costs of transactions are lower. Mostly, investors buy and sell without a direct access to exchanges. Third, they need intermediaries. They need brokers and dealers that let them trade in securities. Brokers put who buys and who sells in contact without any risk exposure. Dealers take a position. Do not forget that no trading activities for issuers, investors, and intermediaries are possible without the intervention of authorities, and the proper functioning of the exchanges need a major role of technology and of technology providers. Now let's explore why do companies go public. There are several reasons that can explain why a company can decide to go public. Hereafter we have the most relevant, also looking at the best practices. A company can go public in order to provide itself capital for growth. Through the issue of new securities that can be listed on the official exchanges, the company collects capital to finance its business plan and its strategies. A second motivation is represented by the need to provide a market for its shares. In this way, the company can have its shares available on the exchange, giving the opportunity to its investors to buy and to sell those securities with good effects on the level of their liquidity. In addition, a listed company is more attractive for employees and can increase the level of commitment of the people that join the organization, also designing remuneration systems that are based upon stock options. A listed company has normally a higher profile with more visibility and reliability. This is performing both considering the relationships with suppliers and customers and referring to the relationships with debt and equity investors. Being a listed company can increase opportunities deriving by acquisition strategies. Raising money is often used for financing future acquisitions. The listed company status quo can improve this capability. Last but not least, a company can go public to raise money for redefine its financial structure. It can increase equity in order to reduce debt. But how do companies go public? Going public is a very strategic decision, whose effects on the company are really very relevant. To go public, it's necessary companies run a long and well-structured process whose steps are the following. First, approval of the board of directors and appointment of the advisory team. Given the level of importance of this decision, it's necessary that the board votes to do it and to propose the general meeting of shareholders to approve the decision. In the meantime, companies need to be supported by specialists that can lead them and optimize the whole process. Second, general meeting of the shareholders and appointment of the sponsor and legal advisors. Going public can change the company and can affect significantly its value. That's why shareholders must agree and must vote for it. The occasion is good to appoint sponsors and legal advisors that can support the process. Third, due diligence. In this phase, a deep analysis is performed in order to extract all the information that are needed for building the prospectus and to give investors a complete set of information, and in particular, the ones related to potential risks and returns. The areas of analysis are many, as legal, fiscal, financial, business, organizational. Fourth, preparation of the listing prospectus and an application to authorities for approval. At the end of the due diligence phase, an official file is prepared with all the information needed for the IPO. It's sent to authorities of the market where the company wants to go public for approval. Just after this, it's possible to officially ask for a listing. Fifth, application for listing at the selected stock exchange. After authorities' approval, the company asks for listing on the selected stock exchange. Sixth, roadshow and book building. When the company is noticed to be authorized, it starts to present itself to potential investors, also in order to know what it's their feeling about the quotation and at which price, if in case they will be available to subscribe the equity. Seventh, final pricing and start of trading. As a conclusion of the previous phase, a final price is fixed and the company starts to be traded on the official and regulated market. In conclusion, managing an IPO is a very important process. We have to select exchanges, we have to understand what are the main actors to involved in the deal, and then we have to run in the most effective and efficient way what is the whole process, managing all the steps that are included in it.